Hello, this is the second part of Mod 27. So I recorded the first one through, and when I went back to put it in Classroom, only 9 minutes recorded. So I'm not quite sure where I left off, but here we go with the second part. This is our new graph for Unit 4. It is called the money market graph, and so this is a new one to know, love, and memorize. On the y-axis, we're going to have nominal interest rates. On the x-axis is going to be Q of M, or quantity of money, and then we call this one just NIR. This is going to be money supply is vertical, and money demand is inverse between interest rates and quantity of money. So money supply is vertical because it is controlled by the Federal Reserve. Money demand is angled because dependent upon changes in interest rates, free market forces are going to change the quantity of money that's going to be demanded. Think back to AD and AS, both of those are sloped because given changes in interest price levels, I should say, you are going to have changes in the quantity of aggregate supply and the quantity of aggregate demand. But MS is completely different because it is an entity controlled by the Fed, so it will always be completely vertical. Money demand is based upon society, specifically the C&I components of GDP, and there's an inverse relationship between how much these groups are going to demand and nominal interest rates. So at higher interest rates, because there's two things you do with your money, you save it or you spend it, at higher interest rates, the quantity demanded of money is going to go down because individuals are going to choose to save. At lower interest rates, the quantity demanded will rise because you're going to choose to spend. So what we're going to look at is how does the Fed control money supply? Monetary policy impacts aggregate demand, and aggregate demand is reflective of your macro graph. So these two graphs are going to tie together. So what happens in your money market will shift factors in your macro graph, specifically aggregate demand. So both fiscal and monetary policy, like I mentioned in class, will always target AD. We do not necessarily have a good policy measure for AS, so we always target AD. All right, so let's look at what caused AD to increase. When money supply increases, it shifts to the right. So if this is increasing, it's shifting to the right, interest rates are falling. Consumers and businesses have an incentive to take out loans at low interest rates. If they take out these loans, this is going to shift AD to the right or to increase it. Vice versa, if you want to decrease AD out of inflation, when money supply is decreased, interest rates are going to rise. Consumers and businesses have an incentive to save money at higher interest rates, and so this is going to decrease AD or shift it to the left. The three tools that the Fed has to impact monetary policy are going to be reserve requirements, discount rates, and open market operations. So the Fed has these three things that it can change in order to change money supply, which then changes interest rates, which then impacts AD. So this is how it links. When we talk about money supply changing, we are talking about people taking more or less loans out at interest rates, and so M1 would be either increasing or not increasing. All right, let's talk reserve requirement. We mentioned this when we talked fractional reserve banking. This is the percentage of deposits that banks must hold on hand at all time, or the smallest percentage of deposits is set by the Fed. So they could hold more, but by law, this is the smallest amount that they have to have. Everything that they do not hold on hand, they will loan out in excess reserves. So what would we do in a recession to help stimulate the economy with the reserve ratio? So banks would, or the Fed would decrease the required reserve ratio. So think back to your T account, reserve ratios on the asset side. So if you decrease the required reserve ratio, you're going to have more money in there than you need to be holding. So banks hold less money in the required reserves, and they're going to move that extra money that they don't need to hold anymore into excess reserves. So imagine your T account, you're moving money from required to excess. Banks are then going to be able to create more loans. The money supply is going to increase, interest rates fall, and AD will rise. Another term for us to note is this is expansionary monetary policy for increasing AD, or it's also called easy monetary policy. If there's inflation, what should the Fed do? Well, the Fed should increase interest rates So required reserve, sorry. The Fed should increase the required reserve. Banks then have to hold money in the required reserves, which is going to give them less money in excess. Less money is going to be loaned out. So we'd say the money supply is going to decrease. AD would go down, and this would be tight or contractionary monetary policy. The discount rate is the rate that the Fed charges to member banks. To increase the money supply, the Fed would decrease the discount rate. This would entice banks to try and loan out as much as they can. They still have to pay an interest rate, the discount rate, to the Fed, but they're also going to charge their customers an interest rate. And so it's going to be more than they owe the Fed. So in the end, they'll be making money. They're going to put any new loans that they get from the Fed into the excess reserves of their bank balance sheet. And so that's how they're going to get more money. To decrease the money supply, the Fed should increase the discount rate, disincentivizing banks from taking out excess loans. And so this would be tight or contractionary monetary policy. The third is the one that we're going to talk about over 75% of the time. This is the one that is used most often. This is why it is talked about so much in AP. This is why the president of the New York Fed always gets to be part of the Board of Governors, because this is where open market operations, OMO, as we call it for short, takes place. So this is the Fed buying and selling government securities or bonds from banks. So when we did the T account, on the asset side, we had required reserves, excess reserves, loans, and securities. So now let's talk about those securities. Banks purchase securities from the federal government as a means of making money. So they buy these short-term bonds, and the Fed will pay them, or the government will pay them interest on these bonds, and then that's a way for them to make money. Bonds are seen as one of the safest investments. You don't get a high rate of return, but you get something, and they're very safe. To increase the money supply, then, the Fed is going to buy government securities. So I'll write it out in the next slide, or I'm going to go over it step by step. But it's buying back securities from banks. So they're basically outstanding IOUs. And imagine a bank has $20,000 in securities on its balance sheet. If the Fed buys those securities back, it is going to give the bank $20,000 cash. The bank will then move that cash to their excess reserves, and now they have money to be loaned out. On the opposite, to decrease the money supply, the Fed should sell government securities to banks. How does the bank get money to buy these securities? Out of excess reserves. So if the bank buys $20,000 worth of excess reserves, they're going to take that money out of, if the bank buys $20,000 worth of securities, they're going to take that money out of excess reserves. So the excess reserves would be decreased by 20,000, but then we would see the security portion of their asset sheet increase by 20. So you are going to remember what's happening to money supply. Which way is it shifting? By remembering this: buy big. So if they're buying securities, they're increasing the money supply. MS is shifting right. Sell small. If they're selling securities, they're decreasing the money supply. MS is shifting left. All right, here it is, just walking it out step by step. If they're buying securities, the money is deposited into excess reserves. The decrease in security increases our excess reserves. Banks now have more money to loan out as new loans. And once that money gets loaned out, we see an increase in the money supply. And then it explains how it works in the reverse. So banks use money from excess reserves to purchase bonds. The decrease in excess reserves increases then securities on the asset side, and the bank cannot lend out the money it is used to purchase the securities, which will cause a detraction or a decrease in the money supply. So we'll definitely go over this again, but those are the three tools of monetary policy.